Beautiful. Great. Thanks, guys. Really appreciate that. Nothing worse than starting a presentation when no one can see what you're talking about. So always like to be a bit careful and a bit conservative outside there. Okay, so the 2022-2023 budget. Nothing would be replete from us if we weren't talking about disclaimers, which is always a fun part of being a regulated firm. Essentially, Atlas Wealth Management, I'm in the Dubai office, and what that means for you is we're dual regulated by both the Dubai Financial Services Authority as well as the Australian Securities Investment Commission. We are what's called a corporate authorised representative of our head office back in Australia, which virtually means from sitting here in the sandpit, we can provide financial advice on Australian topics, any assets that are inside the Australian territorial waters for people from Mumbai through to London and down to Cape Town, which is where this office looks after. This presentation, essentially what this means is any information you garner from this evening should be construed as information or educational purposes only. Do not take this as financial advice. Please speak to your professional. At the end there, we'll provide some contact details if you do want to reach out to us and start that conversation, which a lot of folks are doing in 2022. They've really hit the ground running with taking charge of their finances, and it's great to see. So who is Atlas Wealth Management? We're the leading provider of Australian expat tax financial advice and the winner of multiple domestic and international awards. We're classified as a tax financial advisor with a tax practitioners board in Australia, and we have the pleasure of working with clients in over 35 countries. It flips and flops between 38 and 40 because clients get moving on us, but you get the impression, you get the idea that we do work with clients in all the major regional and centres, as well as some of the most random places too, which is always very interesting in our line of work. All of our financial planners are degree qualified, and most have numerous postgraduate certifications. So what that means for you is these people that are working with our clients, they're not run-of-the-mill people who have random careers. They've been doing this for the better part of 10, 15, 20, sometimes 30 years. So we are match fit in what we do, and we take that very seriously. This evening, we're going to run through a couple of the key services and that we provide. Tax financial advice, which for us is that strategy piece in terms of how you manage your money as an expat. We call it two-dimensional advice, how you join the dots between where you're located, where your assets are, and the complications that go with managing that. Asset management is another big part of what we do, as well as the financial planning side as well too. When we talk about modelling and cash flow, we go through and look at putting meat on the bones when it comes to your expectations with respect to savings and investments, pre-departure reviews for those coming out of Australia, repatriation reviews for those moving back into Australia, and last year we set up the Atlas Mortgage division of Atlas Wealth Management, which helps Australian expats secure a mortgage on properties back in Australia. Okay, so what is the DIFC? This is where We're Home is based, established in 2004. We are essentially a bit of an island in the Sea of Dubai, and what that means is even though Dubai is a Islamic country, governed by Islamic law, we actually operate on a common law basis, which is no different to that of the United Kingdom, Singapore, Australia especially. And what that means is a lot of protection measures that are in place for our clients. So essentially you're protected like as if you were back in Australia, should anything bad in terms of advice be received by you. So who's Brendan James? The guy on the right there looks like my Siamese twin. James is the Managing Director for the Australia, Pacific and Americas region. He runs the Australian office with the team down there, and myself, obviously the guy on the left with the good head for radio. I manage the Dubai office that looks after clients in the Europe, Middle East and Africa region. So on to the agenda, and tonight we're going to be running through a summary of the budget, key takeaways for expats and migrants, the update on the Australian economy, the update on the new proposed tax residency rules, talking through the Australian property, Australian dollar, as well as Australian and international equity markets. And then at the end, that's where we're going to run through that Q&A. So don't forget, folks, as I'm talking, if you do have any questions, don't forget to start to put those up into the question box, and we'll run through those towards the end. Okay, so on to a summary of the budget, and to be honest with you, we were pretty underwhelmed. Given the fact that we are leading into an election, we thought that would have been a bit more on the table, and there's a number of reasons for that, and I'll run through that in this slide. But yeah, certainly not a typical pre-election budget, but this is obviously on the back end of a pandemic, record government spending, record debt levels, and to us, with a short period of time with the election happening next month, there was a very short amount of time that the government would have been able to get any of this promises through. Also, the devil inside me also thinks that Scott's got a few more tricks up his sleeve that he didn't want to announce in the budget, that he wanted to leave for when he's politicking and trying to get re-elected. But at the end of the day, with significant levels of government debt and the government's desire to be seen as fiscally responsible, they didn't want to spend too much money. So to us, this was purely designed as a short-term band-aid to try and address the increase in cost of living, hence why we saw the decrease in the fuel excise, the $250 cash handout to those on Social Security, and as well as the change to the low, medium income tax offset. So to us, picture tells 1,000 words, and certainly in this case, what we're looking at here is essentially the net debt levels for the Australian government going forward into the 2023-24 period. When we look at this, the best way to think of this is when you are buying a property, you'll put down a 20% deposit and you will borrow 80%. So your loan to value ratio is essentially 80%. What we're looking at here, right here, is the Australian debt levels to go up to 37% of GDP. So think of GDP as the house, and the government has borrowed against the economy up to a level of 37%. So what does it mean for you and I and everyone else back home in Australia? It means that the government has more ability to move should they have to do that. Obviously, we're going to run through tonight and talk about inflation and interest rates, and those are key considerations. But the good news is there is that capacity that they can increase spending. As an example, if you look at, say, Germany, they're geared just below 100%, US is well over 100%, and Japan up to 250%. So as far as when we're comparing ourselves to other OECD nations, we're still quite conservatively geared, which is great. Obviously, no debts, but from a government point of view, is always what they try and play at, and we saw that through the 2005, 2006 levels. But going into a post-pandemic period, where it's not so much a matter of paying down debt, but just making sure the economy is still ticking along, we do have the ability for expansion when it comes to policy. So key beneficiaries from last Tuesday night, essentially low to middle income earners who are going to receive a change to the tax offset. It's around about $450 that's extra in their pockets. Social Security recipients, they'll be eligible for up to $250 cash bonus in April. Great for retirees and pensioners. Unfortunately, it's a one-off payment, so that will be well received, but once again, once it's spent, it's not there again. Small businesses got a bit of a nod, having probably been one of the hardest hit people through the pandemic. So in terms of the relief on the future PAYG instalment calculations, that will certainly help their cash flow, as well as the encouragement for companies to train their staff up and go into the cloud through a number of incentives. I'll talk through that shortly with respect to the crunch that they're having on employment and how they're going to fill that gap. Generally speaking, households and businesses, obviously the 6-month halving of fuel excise, to me, that wasn't a very good policy at all. It's going to cost the government around about $3 billion. The key issue that I see is fuel is such a volatile price. So essentially what they've done is they've taken 22 cents a litre out of the price of petrol. And what it means is the price of petrol should fall by that amount. However, if we do see fuel prices rise on the back of the conflict in Ukraine, the biggest problem with that is that whole 22 cent saving that was meant to pass through to mums and dads and businesses has virtually been soaked up by volatility in the oil price. So I think better things could have been done there, but anyway, some's better than none, as most people say, and well, let's just hope that the fuel prices stay around or fall back so that people can feel the real benefit of that. When we're going through and talking about the budget, there's a lot of assumptions that the government utilises in order to forecast and make those decisions. Some of the key ones include gross domestic product, which is essentially the output of the economy, inflation, and some other ones which I'll run through shortly. So what these numbers here show, essentially real GDP So gross domestic product, the productivity of the Australian economy, is essentially going to be running at 4.25% for the 2021-2022 period. And this is what has got a lot of people concerned about. This is this rate of expansion, this growth. As we came out of lockdown from the Australian economy last year, we saw a massive increase in spending, and obviously that consumption growth is expected to be higher than average as people start to run down their savings that they saved up during the pandemic. Some of the growth is obviously due to higher commodity prices, which have obviously risen in response to Ukraine, as well as China's issues as well too. We've seen a lot of issues coming out of China with respect to coal prices that have certainly inflated that. But long story short, we are to see a short-term spike, and then the growth of the GDP is due to sort of moderate over the 2022-23 period into the 23-24 period. With respect to inflation, and this is the big one that's got everyone concerned right now. So inflation is essentially rising at its fastest rate since around 2010, 2011. At the moment, the inflation is rising for a number of reasons, including supply chain disruptions, oil price escalation, increasing food costs. Everything is contributing to the higher costs that people are experiencing when they go to the supermarket or the petrol station or buying goods and services. So Treasury and both Treasury and the Reserve Bank in the past talked about this inflation will be transitory and short-term as we come out of a pandemic lockdown. However, as we're now further through this period, it does look like these increased costs are being baked into the cost of goods and services that people are experiencing. So that's what's got people worried. It doesn't look so transitory. What we're seeing in the numbers right now, and these changes on a weekly basis since the budget was released last Tuesday, I wouldn't be surprised if the CPI estimates for 23 and 24 are even higher again if they can't get this under control. What we're seeing right now, and as I'm talking through these next couple of slides, I want you to remember 4.25% in 2021 and 3% in 2022, and I'll run through that why that's the case. What's got most people concerned about is the lack of wage inflation. So wage inflation is the rate that the average wage across Australia increases in line with obviously inflation and those sort of things, and helping people to maintain their cost of living. So the latest official wage price index, which is from December 21, we revealed an annual wage growth of only 2.3%, and then by 30 June this year, they're estimated to be as high as 2.75%. So remember that, 2.75%, and then I'm just going to flick back a slide and talk about inflation of 4.25%. So the cost of living is increasing quicker this year than obviously what the people's wages are going up by. And then if we look at next year, 2022-23, we're looking at 3.25% in wage inflation forecast. However, CPI is also going up by 3% as well too. The big question is how they lift this number. We saw the trade union organisation come out this week talking about a 5% across the board rise in wages to try and deal with this. In some ways, that can actually escalate inflation even further, which creates more problems. So I'll run through this in more detail very shortly with respect to interest rates and the property market, but that's got us quite concerned moving forward. So key takeaways for expats and migrants. Right now we're looking at obviously not a lot of announcements this year, so key considerations are pretty much all from last year. Change to the tax residency rules still proposed, and I'll run through that in detail very shortly. They also announced the removal of the work test last year's budget for making super contributions from those aged 67 to 74, and that is now being put into legislation, and it is effective from the 1st of July this year. 1st of July this year also too, they've extended the ability to bring forward 2 years of non-concessional contributions. Some people not know this is the bring forward rule on a non-concessional contribution from the age of 67 to 74, and this for us is great news for expats. If you've lived overseas for 10, 15, 20 years and you might have built up a foreign pension, a foreign provident fund and this end of service benefit, the biggest problem that people find when they move back to Australia is getting that money into their super accounts, because you do have annual contribution limits. So by doing this, this enables us to be able to runway out a contribution strategy, getting that money into super in the most tax effective way, and getting the great outcome for clients. So this is a great result for our clients and also expats in general. Key takeaways for migrants. Budget announced for the program numbers for the 2022-23 migration program will be maintained, which is good. I was actually guessing that was going to be increasing to 180, and the reason I say that is because right now with record low employment, or unemployment I should say, we are seeing a crunch when it comes to people getting, or companies getting access to skilled labour and workers. So I wasn't sure whether that was going to lift. It obviously hasn't. In addition, obviously 10,000 places in the migration program from the partner visa category are get moved across to the skilled stream. So what that means is they're trying to bring in the people with the skills and the talent in to fill those gaps. We are experiencing a problem right now where we have record job vacancies and record low unemployment, and companies are going to find it difficult moving forward and continue to grow if they can't get the right people. Okay, so just running on now to the Australian economy, and let's run through and just talk about how the Australian economy is going right now. Don't worry, it's good news, and where we see things going forward and some of the headwinds that they might look at facing. So the chart on the left there, that's what we call the GDP growth. That's the one we're referring to before. You know, as we can see there, 2020 period, we had a collapse and then rebounded very strongly, and now we're starting to moderate out. What we're seeing from a GDP growth point of view isn't excessive. This chart goes back to the early 90s, and as you can see, we've been in this level many times before, and not just through the pointy ends of, you know, obviously the GFC and those sort of things. Through those periods, we have seen, you know, the economy quite robust. And that chart on the right there, and I'm not expecting people to remember this, but last year I showed that exact chart, the contributions to GDP growth, and every single one of those categories was negative apart from imports, which is positive. In this case now, we're seeing all these contributing factors coming through on the homegrown basis, and it's great to see. You know, it's going to help the government return the balance of trade. Obviously, our commodity exports are going to be a big contributor to that. People are wondering why mining investment's not contributing a lot to the GDP growth, and essentially miners aren't forecasting their commodity prices to stay at these levels that they are right now. So what they're trying to do is they're trying to sell their iron ore, their coal, their LNG, their oil for as much as possible, but there's not a lot of spending going on with respect to capex, and certainly not at the same level we saw pre-GFC as well too. If these commodity prices are sustained, then that's when you're going to start to see that mining investment start to pick up, and obviously that may be a cause for concern for the government in terms of too much GDP growth and obviously in turn inflation like we saw back in the early 2000s. Okay, so running through now, we're looking at GDP growth for both China and India, some of our major trading partners, and obviously just recently announced we had the free trade agreement with India, which is great because to us, the Australian economies have been hitched to the Chinese wagon for a long time now. We have seen, especially of late in the last couple of years, that relationship with China isn't the best. And we've seen that ability for China to turn on and turn off the taps with respect to Australian imports. So we saw bans on barley, bans on coal, bans on liquor, and you know, now we've seen China reverse and unwind their coal ban because essentially they need our coal. They weren't able to fulfil their demand. They're about 200 million tonnes short per annum, and we saw a lot of Chinese cities go through blackouts, including a lot of residential places as well too. So that's the first time we've seen that. What we're seeing right now with China, the reason why that line is going down is essentially the manufacturing side is really slowing down. They are really having a lot of problems in dealing with COVID. They're obviously still trying to maintain a zero COVID level. And the biggest problem with that is in a country with so many people and a country that is so spread out and diverse, what we're going to start to see is certain sectors are going to start to grind out, and we're going to see those supply chain issues start to exacerbate globally with respect to their exports. So as you can see, India's done a better job. They certainly were hit hardest in that pullback through the beginning of COVID, but they haven't actually seen the falls that China's seen, and China's PMI data that came out this week certainly wasn't showing a great number as well. So China's got a big question mark on it. With respect to the other advanced economies, obviously looking at the US, Eurozone and Japan, US is our second largest trading partner. People forget that. So that is a good sign that the US economy is going well. And some people were saying too well. And that's why we'll talk about shortly with respect to inflation in the US and what they're doing with interest rates. Eurozone's doing well, and Japan, Unfortunately, they just can't win a trick. Those guys have not been able to pull themselves out of the hole. Obviously, with that RBA economics that they employed a number of years ago, that was great. But then, obviously, COVID has just been enough to put them back into the hole again. Their gearing levels at 250% on GDP isn't the best. And the biggest problem you're going to start to see out of what's coming out of there is going to be, obviously, possibly stagflation, and certainly not good news for the Japanese economy. So running through on the inflation side, the Australian Treasury and the RBA have insisted that the current inflation is transitory. Originally, the RBA said they're not going to raise rates until 2024. I don't know anyone who believed them when they said that. There was no way, with everything that was going on, especially with respect to the inflation that the countries have been receiving over the last 12 months, that they were ever going to be able to maintain that. Long story short, we've seen this in many years with budgets. They were about to be finding a short-term solution to the rising costs. Because right now the government has an issue on their hands. They've got a country that is heavily debt-laden on the back of a property boom, combined with record low rates, combined with almost not record high, but very close to high CPI, as you can see there in the chart going back to the early 90s. The big question for the government right now, and more so the RBA, is do they move now and try and tap the brakes gently by raising interest rates in small amounts and frequently, or do they try and give it a good pump, let the dust settle, and then see what happens to the economy? So what we're seeing overseas right now is almost a 10-horse race is the best way to describe it. So the US Fed, they're taking a hard and fast approach with respect to managing inflation. We saw rate rises in March and 2 more are forecast in May and June, with many talking about the possibility of 50 basis points or 0.5% for each one of those. The Bank of England's taking a wait-and-see approach. They were the first real major advanced economy central bank to raise rates last year. But what they've done now is letting the dust settle, and there's a possibility they may not look at raising rates until later on this year. However, what we're seeing right now on a utility basis is the utility bills coming out of the UK are starting to skyrocket. So the big question for the Bank of England is going to be is how long can they wait, and what do they have to see in order to change their mind? As we can see here, obviously the Eurozone and US are certainly the two leading regions with respect to inflation. There's been talk about inflation going up to 10, 15, sometimes 18% in the US. I don't see that happening. I think we're in a very different microcosm right now with respect to interest rates. We're going back looking at the last 20 years, but not to say they can't do it, but I think the US Fed and Jerome Powell are doing the right thing by trying to get out in front of this and be as aggressive as possible. So the biggest concern we've got for the inflation side is the labour market. Cost of living is rising, and what we're seeing right now is wage growth is not rising at all. And as you can see in the chart there, going back to 2014, 2015, we really haven't changed a lot in that period of time. So how I guess the commentary out of the last 12 months from the government and from the RBA was that a shortening of the labour market is going to lead to people being paid more to do the jobs they're doing. We haven't seen that. And I think what's actually happened is COVID has forced a lot of businesses to streamline their operations and also to digitise some of their services. By doing that, they've been able to reduce their headcount, they've been able to be more efficient and lean, and we've also seen, obviously, those announcements coming out of Canberra in the budget this year with respect to encouraging companies to go into cloud. They're going to give you a 120% tax deduction for every dollar you spend by taking your business into the cloud. But what it means as well too is we may not have to have as many people doing the jobs that we did obviously pre-COVID. When you look at sectors like hospitality and those sort of things, you can't digitize that. So there's still a demand in that area, and companies in that area are still experiencing issues. The problem they're going to experience is how do they grow, how do they prosper if they're not able to hire more people. One of the major concerns is the Australian market, New Zealand as well too, fell quite heavily recently in a survey with respect to working holidays. Australia was always in the top 5 in that regard for many, many years. However, with their sort of Fortress Australia approach, it really has scared off a lot of people. And we saw both New Zealand and Australia fall last week in that survey, which is quite concerning, because we do need these people to come in and fill those gaps and do the jobs that Australians don't want to do. Obviously cotton chipping, bar work, waitresses, those sort of things that really at the end of the day we do rely on that transient work population to do. So I think the Australian government's going to have to do a lot more to try and encourage those people back, because they're the ones that are going to enable businesses to grow. Because at the moment, as you'll see shortly in the unemployment numbers, we're in a very, very tight pickle at the moment. So as we go through here, we're looking at the labour utilisation rates, and essentially we've got two lines there on the left-hand chart. So you've got the unemployment line, unemployment rate, which is the bottom one, and the underemployment rate. And I think this is where we're going to be able to get a bit more capacity. So as you know, and you probably heard in the press, Australian unemployment down at record lows. However, the underemployment rate hasn't got down to that same level yet. And underemployment rate is essentially full-time workers on reduced hours for economic reasons, or part-time workers who will be unavailable to come in and take more hours. This is the other reason why Canberra is using their budget to try and encourage businesses to train up staff and bring on more people to try and get that underemployment rate down. If we can get that down at the moment, there's a disparity of about 3.5%. There's more people there that they can get in. On the right there, you can see job vacancies and advertisements have gone through the roof. So there's a problem there in terms of companies in Australia are going to be fighting over the same people in order to fill those roles. Good for the consumer. Doesn't mean they're able to go to get a better job and better wage. Not sure yet. We saw obviously Canberra come out and say, their response to wage inflation not being as aggressive as they were hoping was to ask for a pay rise or get another job. Easier said than done. So, and bear in mind, we wrote this presentation last Thursday before we ran the Dubai seminar, and this is even proving even more so now. So rates may not stay on hold for long, and as we can see there, the 10-year bond yield, it's turned. It was turning back in 2020. It was factoring in, pricing in that interest rates were not sustainable down where they were, and it is going to lift. We've seen fixed rates increase by quite a dramatic amount. I think the biggest one I've seen in the last 12 months is about 184 basis points, or 1.84%, an increase in fixed rates. So now, if you are considering fixing your mortgage, the market's already priced that in. So don't think you can get ahead of the market and do this before the Reserve Bank lifts the official cash rates. Banks have done it. They've been doing it for the last 6 to 12 months in terms of pricing in these increases on fixed rates. And fixed rates, record low fixed rates, were virtually what the catalyst for the property market was. People get in, they can lock in a very low rate, and they had that peace of mind to make a larger purchase than they normally would. As we can see here on the right-hand chart, we've got the 10-year government bond yields for the foreign countries, US, China, Germany, Japan as an example. And mainly looking at US and to a lesser degree Germany, we have seen, and we are seeing right now, obviously a big turn in those bond yields, and they've actually jumped again in the last couple of days. What we're going to start to see is more and more central banks are going to unwind their balance sheet. The US and US Feds, to a large degree, were some of the largest bond buyers through their QE packages, and what we're going to start to see is those bond yields creeping up even more as the central banks get more aggressive. So what we're looking at for headwinds for the economy, and there's actually one line missing there too, which I'll cover on. First of all, the escalating conflict in the Ukraine. So obviously that is leading to issues with respect to supply chain. It's amazing in the role we sit. We talk to a lot of people in a lot of different categories, and one thing I've learned in the last couple of weeks that Ukraine is one of the largest manufacturers of wiring looms for car manufacturers in Europe. So that is going to translate into issues as well as the semiconductor issues as well. Interest rate increases, the market is always nervous about that from a consumption point of view, and then that in turn leads into a lack of wage inflation. If rates are going up, the cost of living is going up, but people's wages aren't going up at the commensurate amount. The big question is, who's going to be the first to fall? So running on to the tax residency changes, and what we're looking at here right now is essentially a case of nothing to report ... And by that I mean we saw the announcement come out last year calling the modernising of the tax residency rules. I agree, these rules were set back in the 1930s, 1936 to be exact. Under the new rules, they've essentially been designed to take into account a very different workforce and a very different expatriate population. In saying that, you must understand that we've got a border taxation report, all 184 pages back in 2019. We've got a 2-page report from Canberra out of the budget last year saying they're going to push this through. The devil is still in the detail. We still have not received the expenditure memorandum. We still not have seen the legislation that surrounds this. So just because the Board of Taxation recommended X, it doesn't mean Canberra's going to do X. It could do Y. They'll have their own different interpretations, their own policies they want to put in, and that's why we're desperate to see what the devil in the detail looks like with respect to this. Are they going to pass through the Board of Taxation's recommendations in full and unchanged? Who knows? Maybe. But what we're going to start to see is a lot of talk about this in the coming months. And the reason I say that is when the initial changes were announced last year, Labor did come out in support of this. So it is a bipartisan policy. Whoever gets voted in next month will more than likely push this through. In terms of how it looks, we're going to have to wait and see. This is a very big piece of legislation. As I said, it's been around since 1936. It is going to take some time to do it. But the first thing I want to say to folks out there, because I do see a lot of chatter in the social media groups, this does not come in before 30 June this year. That's unequivocal. Whoever gets voted in, they've only got a month essentially to form government and pass legislation through both the lower and upper house. And even if it did come in as of 1 July this year, the Board of Taxation report did recommend an implementation period of between 12 and 24 months. So just bear that in mind. If the legislation does come through, when we see the explanatory memorandum, we will let everyone know. So make sure you do follow our social media channels. Obviously, for clients, we'll let you know directly. More than likely, whoever gets voted in will release the explanatory memorandum after 1 July this year. What that will mean is that explanatory memorandum is the explanation of how the legislation is going to work, and that will give us all the details. There's a lot of conjecture out there whether they're going to go through the 45 days, maybe a 60-day, maybe a 90-day. We don't know. You know, we've done a lot of work in the background trying to highlight to Canberra the inadequacies of the 45 days, as well as other issues as well too. But long story short, there will be some sort of component with respect to this bright line test and the 183 and the 45 days. So let's just run through, and I'm presenting this on the assumption that everyone who's watching this today and tonight is essentially already an expat. So we're not talking about becoming an expat. I'll touch on that briefly, but this is more so for those folks who are already living overseas. The new rules are essentially bad or devastating for everyone. And for most, I'd say it provides a lot more clarity that they can't experience. So if you think of yourself and you look at that box there, the first grey box, did you spend 45 days or more in Australia this income year? So if you went back you used all your annual leave, in your case, the United States, you've only got 2 weeks, so that's not long, it's only 14 days. For everyone else, if you got up to 30 days, if you spend 30 days in Australia, then you are a non-resident. You can own half of Sydney, half of Melbourne, you can own everything. You are a non-resident, black and white. No one can take that around from you, not even the ATO. So this is where we're going away from that subjective assumption in terms of what you're a resident or non-resident now to now being a very black and white binary. Are you a resident, non-resident? So did you spend 40 days or more, 45 days or more in Australia this income year? If the answer is no, you are a non-resident, regardless of everything else. If you did spend more than 45 days in Australia, then we have to apply the factor test. And essentially the factor test, a forward factor test, and you only need to fail 2 of the 4 in order to be classified as a resident for tax purposes. So let's run through those. If you do fail 2 or more, then you are a resident for tax purposes, and it starts on the day that you qualify for that. If you fail 1, then you're okay. So people are going to have to really look at their finances and work out how they're going to manage that going forward. At the end of the day, we don't have the devil in the detail, but we do know that this is going to be a similar test, if not exactly this, going forward. So start to think about, how your lifestyle is. Are you spending over the last couple of years more than 45 days a year in Australia? You might want to look at changing that or revisiting that. So what are the 4 factor tests? Essentially, you've got a right to reside in Australia. That's most expats, pretty much all of them. Accommodation, Australian accommodation factor test, the Australian family factor test, as well as the Australian economic connections. So right to reside in Australia, you have a right to reside permanently in Australia for immigration purposes. You can turn out up the border, flash your Australian passport or PR. move into the country, and that is a right to reside. So as I said, pretty much everyone fails that test. Second one is the accommodation test. And essentially, in layman's terms, if you own a property but it's not rented out and you can land at the airport, go straight to that property and gain access to it, put a key in the door and chuck your bags down, then that is a failure of the accommodation test. So that for those folks who have property back in Australia that is not rented, this is going to be a key concern for you. This also covers people who have timeshare arrangements. Even though you don't own the whole building and the whole facility, if you do have access to a timeshare property back in Australia, this is also covered on that. However, where the property is owned and rented out, even though that is fine, the other issue you got is the economic assets test, which I'll cover off on shortly. So the Australian family factor test, an individual will have an Australian family and thus satisfy the third factor if their spouse or any children under the age of 18 are generally located in Australia. At the moment, and this is why we need the explanation memorandum, we don't know how this relates to people in boarding school. So if you've got kids back in boarding school and the husband and wife are living overseas, does that form a failure on the factor test? So we need more clarity on that, and we already have let Canberra know. Spouses include partners in all de facto relationships regardless of sex, and this is not expected to include estranged marriages. So economic connections, and this is the one that most people are concerned about. So when it comes to economic connections, an individual will have economic connections with Australia where they are employed in Australia, so that's not, hardly any expats. They actively participate in carrying on a business in Australia, or they directly or indirectly have interest in certain Australian assets. So those Australian assets include taxable Australian property, and taxable Australian property is essentially a house, apartment, a mining lease, a farm, things that you can kick. A bank account with Australian bank with significant cash deposits. They have not said what that amount looks like. My guess, and it's an educated guess, is that it will be around about 250,000 Australian dollars. And the reason for that is they do have other legislation using that dollar amount limit that I think would fit nicely into there. An interest in a family trust. So a number of Australian expats do run family trusts. So that is a key concern. The last one, recipient of an Australian Social Security in the preceding income year, pretty much little to no expats would be fall under that. So when we do look at that situation under the economic connections, a lot of expats will possibly fail that test if they've owned property. The way you fix that, you don't spend more than 45 days in Australia. So it sounds simple, but it is under the new rules, the way that things are going. Let's hope we can get it up to 60 or 90 days. There's stuff we're doing in the background right now, laying the framework for that. So when we do know which government is going to come in, we can hit that button and get very noisy. So watch this space. On to the Australian property market, and needless to say, the boom that it's experienced in the last 2 years has been ridiculously crazy. Clients have been offered stupid amounts of money for their property, and a lot of them are taking it. I guess I call it almost the toilet paper phenomenon of Australia, of people buying lots of toilet paper even though they didn't need it. You can lend it across the Australian property market as well too. And yes, there were concerns regarding supply issues, but also too, this was mainly driven by very, very cheap cash, record low fixed rates, and you had a Reserve Bank, it was pumping up to $180 billion into the major banks, lending that money to the major banks at 0.1% to then lend on to you and I. So we saw very much a record event from a liquidity point of view. Obviously, there's two things that drive property prices: interest rates and capital. And obviously overlay that with sentiment. The biggest concern we have for property right now is you do have an environment which unequivocally we are going to see rate rises, and we are going to see them this year, and they could be hard and fast depending on what's going on. Yesterday, on Tuesday, we saw Governor Lowe, who's the Reserve Bank governor, change his tune dramatically when it came to an update on rates. So in the past, he's always said, well, watch this space, watch this space. He didn't say that anymore. He said this is happening. So when we're looking at the futures markets and cash markets, they're pricing this in. They've been pricing this in for a while now. So financial markets are implying the official cash rate hits 1.87% by the end of 2022, which translates to at least 7 projected interest rate rises this year by the Reserve Bank. It may not be 7, it may be 5, and those rate rises may be 50 basis points instead of 25. but the market is pricing in that rates are going from 0.1% to 1.87%, which is a dramatic increase. The cash rate is expected to rise in June. So when I wrote this, this was actually back on Thursday, and everyone was pricing in that in June, rates are going up between 15 basis points and 25 basis points. However, given yesterday's commentary, there is a very good chance that we may see a rate rise next month. Normally, the Reserve Bank doesn't like to change rates around an election period. They like to be agnostic when it comes to both parties. They don't want to give one the advantage over the other, but that decision may be taken out of their hands by the inflation numbers they're seeing right now. Traders are ascribing an 88% chance of the probability of a 25 basis point increase, and also almost even odds of an outsized 0.5% move in June. We may even see 25% in May and 25% in June. You know, it's going to be an interesting time to be a bit of a market and data nerd like we are in terms of looking at this, because this is going to have wide ramifications on that property market, because it is solely relied on record low rates. You can have all the immigrants coming in the world and all the change going on that are a catalyst to buy those properties, but if people can't afford those properties, that's going to be the biggest issue. Futures markets are forecasting the official cash rate being 3% by August next year. So once again, it's currently sitting at 0.1. Big consideration you need to understand is over 1 million borrowers have never experienced a mortgage rate rise in the period that they own a property. So there's a massive subset of mortgage holders out there at the moment who've only ever known a decreasing interest rate and decreasing mortgage repayments on their cash flow. When you look at this scenario, we're looking at a New South Wales average home loan of 830,000 Australian dollars, which equates to an extra $1,427 per month in repayments, or $17,124 per annum. Big numbers. Overlay that with rising inflation, overlay that with lack of wage inflation. Not for everyone, but for some folks out there, it is going to start to get a little bit messy. We're looking at the equivalent, obviously Australia's a taxing nation, so in order to find $17,124 per annum, people are going to need to find $25,000 in pre-tax income that you'll need to just to make the same repayments. Unfortunately, Australian mortgage holders did not take advantage, some did, but not all, of the low rates by increasing their repayments to match an assumption that rates would rise. So much so that the Reserve Bank and the OECD both commissioned and released reports last year about their concerns about Australia's debt levels on property. So defaults are a concern. Everyone's seen this chart before. It's one of our most common charts, and just as a bit of a flavour for those who haven't joined us on one of these calls before, all of this data is agnostic. This all comes from the Australian Bureau of Stats. We don't have agendas. We don't accept commissions. We don't sell property. We don't do this. We don't sell product. For us, people pay us to advise them what they should do. And where we go for this data is the Australian Bureau of Stats. We don't take this from any publications or anyone with agendas in the background. It's for us, the Australian Bureau of Stats is impartial. Whether the property goes up or down, they're just reporting the numbers. As we can see here through the 2008 period, we saw that massive spike on business. That is pretty much the GFC. So we can see there, that bottom line there, that was the spike in housing defaults. If we run to the right-hand side there, and we follow that line up, we can see that the housing defaults have been on the increase even before the pandemic. So a lot of folks out there have been spending too much money on smashed avocados and cappuccinos. What's actually happening right now, even with the protection measures that were put in place through the bulk of the pandemic period, people were still defaulting. We've seen a dramatic reduction in the amount of personal loan defaults, so that's credit cards and cars and car loans and those sort of things. But unfortunately, the housing defaults are still at a dramatic increase and dramatically higher than we were back in the top of the GFC. So that just gives you an idea of what's going on. And let me just leave this with you right now. Massive record defaults and the lowest interest rate environment that Australia's ever experienced. So that's what has got the alarm bells ringing for us. Running through looking at mortgage stress. Mortgage stress is essentially calculated for those folks, once they've paid all their bills, they've got less than 5% of their net income to spend on whatever they want to spend. So as we can see here, the bulk of that is through the mortgage bill, places like Campbelltown, out up to St Mary's. But the interesting one to note is you can see North Shore, Sydney and eastern suburbs aren't exactly doing the best. There's a lot of folks there who have spent more than they should have on their property. And whether it was a keeping up with the Joneses or what that factors were, at the end of the day, there is mortgage stress, very much so in Western Sydney and to a lesser degree in eastern and northern suburbs as well too. Obviously, what we're going to start to see as the rate rises start to take in is, we're watching these colours very carefully and seeing whether we get to start to see more darker colours come through. Apologies, I'm colourblind, so when it comes to looking at these colours, I don't really talk about colours, I talk about shades. But the biggest concern is obviously, if we are going to see suburbs get up into the 40s, the 50s, 60s and 70% in terms of financial stress, that's going to set alarm bells off, and it certainly doesn't bode very well for property. In Melbourne, once again, in the mortgage belt, to a majority where people are feeling the worst. And what we're going to start to see out of all these markets is Sydney and Melbourne are going to bear the brunt of it if these property markets do pull back. Reading reports coming out of the major Australian banks, the banks are forecasting property to go down over the next 12 months. You've got, I think it's Westpac, 14%, CBA's at 10%, and the other banks, done the gains, it's down at 4%. But this is bearing in mind pre any sort of rate rises. This is the forecast going through. In Brisbane, not as dark on the colours there, which is good, but they haven't had the meteoric rises that obviously the southern capitals have experienced as well too. So we shouldn't expect the Brisbane market to feel the brunt of it as much as the southern states. If you cast your minds back to 2017, 2018, when APRA changed the assessment rate and made it very difficult for borrowers to get cash, we did see both the Sydney and Melbourne markets fall 15 to 20%, whereas the Brisbane market only fell 5% in that period. So we haven't seen the meteoric rises up, but hopefully we don't see the collapses down. A lot of talk going on regarding the Brisbane Olympics and what's going on there. Look, it's a long time and a lot of water to go under the bridge between now and the Olympics. And in a rising rate environment, you'd have to be a betting man to say that Brisbane is not going to feel at least some of this effect when rates start to rise and bite in. So running through the headwinds for the property market, rising interest rates. It's all about interest rates. It's all about capital. With little to no wage growth after accounting for inflation in the coming years, it's going to really start to bite into Mr. and Mrs. Smith when it comes to managing their budget. The other consideration and the other problem that the property market's going to have is the rapidly rising building costs. We've seen building costs rise dramatically over the last couple of years, and now we have the floods, which is going to cause obviously a rush to get building supplies with people trying to rebuild their home through insurance claims. So the cost of a house, even though the land is not going to change value, is going to go up. It may make it more and more difficult for companies to, deliver low to middle price housing. We've seen a number of developers going bust over the last 12 months because they've all agreed to fixed price contracts. The big question is going to be is what's going to happen with the underlying asset of the property in terms of the land, but also are people going to be able to build? That's the biggest question. On to the Australian dollar, and this one's causing a lot of consternation with a lot of expats at the moment. Unless you're holding primarily Australian dollars, then in that case you're probably enjoying what you're seeing right now. At the moment, the Australian dollar's been very volatile in the last couple of weeks, now well over 75 cent to the US dollar range. There's a lot of talk as to whether we're going to start to see the Australian dollar with a 6 in front of it, and I'll run through shortly why I don't think it's the case in the short term. And if any of the case, there's a possibility that the Australian dollar may appreciate and get stronger up towards the 80 cent mark. When we're talking to clients, we're always talking about diversifying your assets, and that is not only just in currency, but in assets as well too. You need to make sure that you're not just holding US dollars or sterling or euros or any sort of pegged currencies like a dirham or a reals, because as we're seeing right now, we're seeing a lot of speculation as to where the currencies are going. And we saw back in January when the dollar dipped below 70 cents for about 2 minutes, that was essentially traders going in, shorting the market, thinking that if a conflict in the Ukraine does kick off, then people are going to rush to US dollars. It didn't happen. And the reason it didn't happen is because any conflict caused a spike in commodity prices. And as a result, obviously the Australian dollar is highly driven by commodity prices like we'll see over the page. So conflict in Ukraine has driven up commodity prices. Ukraine, obviously I discussed before about the worrying looms. Wheat, they're a large wheat exporter as well too. They're obviously not doing that at the moment. So Australian wheat prices have been going up. That's going to contribute to Australian wheat exports as well. It's going to make the Australian dollar more appealing. People are going to have to buy Australian dollars to settle those contracts. The other one too, which is quite a random one, and everyone knows about the semiconductor shortage that's going on in the market right now. Believe it or not, there is actually an element in 2 mines in Ukraine that are used to build the chips for semiconductors. So that's going to add more constraint on that supply of semiconductors. Companies right now are trying to make do and use other materials, but that will take time to iron out. So that's just something for the fact file there that I didn't realise up until about 2 days ago. China's unwinding the ban on Australian coal has also inflated prices. So as we can see there, both in the iron ore, thermal and coking coal, we've all seen dramatic price increases across the board, which is obviously underpinning and providing a safety net under the Australian dollar. The one to watch is not actually the spot price, but it's the export price. And the export price is the contracted price that these companies and the resource companies have contracted to sell these commodities to a provider overseas. Best example I can provide of the difference between the export price and the spot price: when you go travel, on a holiday, you might buy an airline seat 6 months in advance. That's obviously cheaper than buying that seat on the day that you're departing. And that's virtually what this is. This is companies going and saying, we'll sell you our iron ore for the next 6 months at this price. That's a contracted price. So on the Aussie dollar versus US dollar, and a lot of expats probably not going to like what I'm going to say here, but as we are seeing the beginning of a tightening cycle by the US Federal Reserve, that has historically penalised the greenback in favour of the Australian dollar. The reason for that is the inclination, or the implied movement of that is, if you are raising rates in the US, there is the concern that the US economy is going to slow and you don't want to be holding US dollars. Where the dichotomy happens right now is if all of the central banks start to raise rates at the same time, that may not be the case. So that's why we're watching the Australian RBA very closely to see if they actually pull that off or not in the next couple of months. The Australian dollar has appreciated in 6 of the past 7 US Fed cycles, not including this month's interest rate rise, which was back in March, which is the first for the US economy since 2018. And as I said before, traders shorted the Australian dollar as a hedge against deteriorating risk sentiment in the lead up to that invasion, but that didn't work for them. The big one for us right now is going to be what happens in the US, what happens in Australia. That is going to dictate what happens to the Australian dollar. People keep asking me, what's going to happen with the Australian dollar? Is it going to have a 6 in front of it? Is it going to have an 8 in front of it? Those, and those on the call should have pretty good memories. Remember back in 2012, when the Australian dollar was sitting at $110 to the US dollar. That was purely driven by commodity prices and an interest rate differential. So do I think we're going to get to that point? No. But do I think there's a chance of the Australian dollar having an 8 in front of it? Yes, I do. So once again, currency risk is a big risk that Australian expats have to deal and cope with. So make sure when you are looking at your finances, you have a good spread of currency exposure, because if the dollar does go up to 85 cents and you're holding sterling, or you're holding euros, or you're holding dirhams or US dollars, it may not look as good on the balance sheet when you put those numbers into your Excel spreadsheet on the end of the month. So look, watch that space. I think the only way that I can see the dollar having a 6 in front of it, there's probably 2 events. The first event will be some sort of black swan event like we saw back in March 2020, when there's just a rush and a risk-off strategy into US dollars. People panic. They just want to hold the mother currency, which is US dollars. Obviously, that's why we saw the dollar back at 56 cents back in March in 2020. The only other time I think that we're going to start to see a reduction in the Australian dollar price against the US is a fall in commodity prices and the Reserve Bank holding off on interest rate increases. Put your fund manager hat on, think like a fund manager. If you're chasing yield and the US Feds are increasing their yields, but in Australia they're not, you're going to sell your Australian dollar and buy US dollars to get that return. So if we do see the Reserve Bank try and hold off for rate rises and the US goes very aggressive, that may in turn start to move that across as well. So now let's run through on the Australian and international equity market update. And look, it's been an interesting time to be in the markets. To be honest with you, we saw a lot of conjecture, especially in the early part of this year, and there's been a lot of focus on what happens with Ukraine and how that's priced into markets. Bizarrely, and I won't say bizarrely because there's a reason why, but the market has actually totally absolved any economic impact that Ukraine is having on equity markets at the moment. We are back to where we were back in the beginning of the year, back on the 12th of January. And believe it or not, as you can see there, just after the beginning of 2022, we saw a dramatic drop, and that's got nothing to do with Ukraine and nothing to do with Russia. That was Jerome Powell talking about up to 7 rate rises that may occur in the coming year. So the market is more concerned about interest rates than it is about Ukraine. Obviously, on the human side, what's going on in Ukraine is incredibly devastating and just breaks my heart being a father, seeing kids going through this sort of thing. But as far as from a dollar sense term, the market has moved past Ukraine and is not ascribing any attrition to future returns going forward. As you can see here, similar sort of thing going on with the US markets at the moment. So they've totally discounted Ukraine. What we're going to start to see is when we saw that sell-off that happened back in January, when Jerome Powell made that announcement on the 27th of January, normally you'll see, if markets are panicking, a rotation from equities into bonds, from risk into safety. That didn't happen. All we saw was the fast money, the leverage money come out of the market, but it did not go into the bond market. So that to me tells me that the flash traders, the HFTs, those sort of guys who are blow in the wind type investors, they were purged out. What we're going to start to see now is rotation. And if you see the market will go up by 0.5%, you'll see a massive disparity between what we call value stocks and growth stocks. So growth stocks are your tech stocks. Tech stocks rely on a low interest rate environment. They rely on that because it's the risk differential that investors are happy to either put money into a bond and get a guaranteed low return, or put money into a tech startup and get a high return. Obviously, the risk with a tech startup is higher, and you want that interest differential between the two to be as large as possible because you're assuming and taking on a lot more risk. As interest rates start to rise, that gap starts to shorten. And then investors are going, well, you know what, I can put money into a tech stock, but I could lose the whole lot. Or I can go and get a 3, 4, 5% bond yield from a central bank and have more security. So that's why tech stocks or growth stocks don't do as well in a rising rate environment. However, the good news is on the other side, you have what we call value stocks. And value stocks are companies that have been going for 1,000 years. They have a balance sheet. They make profits. People are saying to us right now, well, if CPI goes up and official cash rates go up, how's that going to affect the markets? And the key consideration is actually the markets will be fine as long as they get it under control. If you think back, the official cash rate, the safety net for most Reserve Bank governors is 2.5% to 3%. And the market has operated for the last 100 years, and the official cash rates have been at that neutral level, and the economy has prospered and boomed. So just because we're rising rates, it doesn't mean the wheels are going to fall off the economy, as long as the inflation doesn't get out of control and we see official cash rates, instead of being at 3 and 4%, get up to 5, 6 and 7s and those sort of things. People are saying, are we going to see numbers like we saw back in the 1990s? I don't think we will. That was a very different environment and a very different economy that we're dealing with right now. We do have capacity. We do have the ability for expansion measures coming out of Canberra. So the big thing for us right now is they're keeping their powder dry. They're not spending money they don't have to, but we're going to wait and see how the Australian economy goes for the next 1, 2 and 3 years. To us, as long as the official cash rate doesn't get much further above 4%, the economy is okay. We're seeing companies running on record low LVRs or loan to value ratios. They're not carrying the amount of debt that they did back in pre-GFC and through the GFC. That's what brought them undone. Companies have a very long memory. They did not want to get back to that level. When you look at the average loan to value ratio for a company back in that period, most companies were running between 50 and 60%. Right now they're sitting on 30 to 40%. So it's a big difference, and they're able to manage their cash flows and manage their payments more successfully. So on the market commentary side, the sell-off in government bonds is supporting equity markets. We are seeing people coming out. We've also seen the US Feds talk about a lightening of their balance sheet. So there's getting to see more and more sales on the bond side, which is going to spike US bond yields. People are asking us right now, what happened with the inverted yield curve last week? To us, normally this is an indicator of a recession. And essentially what this means is a inverted yield curve means that the 2-year Treasury bond is providing a higher yield than a 10-year Treasury bond, which is not normal. And that implies that rates are going to rise then fall dramatically, which implies a recession. At the moment, we saw the inverted yield curve correct itself very quickly, but I think what we're seeing right now is a lot of distortion in the bond markets by central banks because they are the largest owners of bonds. They've been buying that as part of their quantitative easing packages for the last 2 years. Going forward, where we're going to start to see things pan out right now, I think obviously Treasury notes are going to appreciate in value on the yield side as we start to see more sell-off by central banks. And one more thing I just want to leave, and people, the Ukraine conflict was a great example of this, certainly with clients that we talked through once it all started to kick off. And people were picking up the phone to us and say, hey, Russia's about Ukraine, it's World War III, acting very scared. The interesting thing is they didn't pick up the phone to me when Jerome Powell talked about interest rate rises on the 27th of January, so almost a month before, but the market fell further. So when it comes to managing your own expectations and managing your own emotions with respect to investing, this is one of the best little gems I can give you, and that's what we call the VIX index. It's the volatility index, it's calculated on the Chicago Board of Exchange, and I won't go in and bore people with how it's calculated, but essentially this is a measure of the market's apprehension or excitedness with respect to investing. So the higher the number on the chart, the more risk, the more fear that's in the market. And if you're feeling uncertain or uncomfortable with what's going on in the markets right now, you can actually just type in VIX index up on Google, you'll see this chart. And you'll see very quickly whether that uncertainty or that concern is, are you entitled to be that way? Or is everyone else cool as a cucumber and it's just you? So we start to see that concern coming out when we look at events like Ukraine and those sort of things. The press obviously have a lot to play with it. They know how to play with your emotions. They know how to create a lot of that consternation. So the biggest thing I would say is if you are feeling a little bit uneasy and you're not sure whether this is normal or not, just type in the VIX index and you'll see very quickly on equity markets whether people are fearful or whether they're greedy. Righto folks, Q&A time right now. So we're running about 5 minutes late, so sorry that. I do tend to yabber on a bit too much. So start to type in your questions and for the next half an hour or 40 minutes or whatever, how long it takes, we'll start to go through and answer those questions. Just on a quick one as well too, while I'm doing this, a lot of these changes coming through in the next 6 to 12 months. I'm talking about tax residency rules and those sort of things are going to be communicated by us through our social media channels. So make sure you jump on our Facebook page, our LinkedIn page, Twitter, as well as Instagram. Instagram, there won't be too much on that side, lots of photos, but more so the content side will be on Facebook and LinkedIn. Also, to a shout out for our podcasts. We've been running 2 podcast channels over the last couple of years. One is called the Expat Chat Podcast, and James and myself, usually on a weekly basis where possible, we jump on there and run through and talk about the latest issues affecting expats, and also to do some deeper dives and go into more detail on certain topics. The last one we talked about was self-managed super funds and how that affects expats. So certainly you can just Google Expat Chat Podcast. We're on Apple, we're on Google, we're on Spotify, so all the major podcast hubs. We also have another podcast channel called the Expat Mortgage Podcast, which is run by Jeremy Harper, who's the Managing Director of Atlas Mortgages, as well as James. And they're more talking about topics regarding financing loans with properties and how expats can get loans and also maintain loans as well too. So a bit of housekeeping there for you guys. Also too, for those on Facebook, we do have a Facebook group that's well over 1,000 people now. It's called the Australian Expat Financial Forum. I'll put links to all these things. We'll be sending out a copy of the recording to both those who registered and were able to attend and those who registered and were unable to attend. So don't be too worried about trying to remember all these bits and pieces. We'll also be sending out a copy of the presentation as well. Great for lining kitty litter, great for chocking doors. If you do want to read it, fantastic. But essentially, we just want to give you guys all the information possible to help you make informed decisions. So running on to the questions. Here we say from Natasha, say the legislation passes and I spend more than 45 days in Australia, do I get a principal place of residence for CGT despite the fact of it being that my principal place of residence is my home in the Cayman Islands? Look, interesting one. I'm not going to, and one thing before I start answering questions to you folks is I can't provide personal advice on these calls. Everything is general, so we'll talk about in general concepts. So Natasha, essentially what it means is you'll be a tax resident for tax purposes, and then with that you do get afforded some of the abilities with respect to the 50% capital gains discount. The main residence exemption is an interesting one, and the reason being is because you have to actually be in that property as a tax resident in order to gain access to that exemption. So with respect to having a property overseas, and this is a good point, and this is one of the strategies we use with a lot of clients who are repatriating back to Australia. So yes, losing the MRE back in the 1st of July 2020 was a very sad event for expats. However, when you're moving back to Australia, you can also use that legislation in its reverse. So let's say for my example here in Dubai, if I own a property here in Dubai and I don't own a property back in Australia, if and when I move back to Australia, what I can do is not sell that property in Dubai. I can put a tenant in for up to 6 years, as long as I'm not renting a property in Australia, sorry, not buying a property in Australia, and the Dubai property is still my principal place of residence. I can let that property sit overseas and accrue in value and sell it within that 6-year period. You are able to access the main residence exemption by being resident in Australia. So just because the property is overseas, there's no carve-out for that. So for those folks who do own property overseas and who are looking to possibly relocate back to Australia in the future, just be mindful of that. It's a good strategy that we've used a number of times for folks who they don't want to buy a property in the property market in Australia because it's too hot, but they don't want to sell their property overseas just yet. They want to move back to Australia. They want to rent. They might be moving to a new city that they've lived in before. So it gives you a bit more time up your sleeve. You don't essentially have to sell that property too quick or too hard. So Natasha, I hope that answers the question. Mariani, what if I stay in Australia is 50 days? Does this mean I'm a tax resident for just 5 days? Is US-based income considered during these 5 days? Okay, good question. So once again, I'm not going to refer to your case in general, in specifics, but talk about these concepts in general. Long story short, what this means is if you're there for 50 days, it doesn't mean you're a tax resident. You then have to fail 2 of the 4 factor tests. That's the right of abode, the accommodation test, the family test, and the economic assets test. So if you are in Australia and you have a right of abode in Australia and you own a property in Australia that is rented out, then yes, you will be considered a tax resident. Now what that means is it's not for those 5 days, it's for that financial year. The bigger danger for expats, if they do fail those tests and are categorised as a tax resident, is what we call ceasing residency. So in the past and under the current rules, if you wanted to leave the country and become a non-resident, you jumped on a plane, you moved overseas, you got a job, you got a house, apartment, villa, and then as long as you're overseas for 2 years and your behaviours match that of a resident in that country, that was your categorisation of being a non-resident for tax purposes. Under the new rules, this is where it's worse for those who are about to become expats than those who are already overseas. In order to be considered a non-resident from the date of departure, you have to leave the country with a 2-year employment contract and work in an environment that has accommodation available. You can go and rent a property. If you do not have a 2-year contract, so you either had no contract or the contract's for 1 year, and you'd leave the country, you may not be considered a non-resident for tax purposes for up to 3 years. You essentially have to prove your non-residency by not going back to Australia for greater than 45 days for the next 3 years, and then in the 4th year, you're a non-resident for tax purposes. This is a key consideration for those folks who are moving overseas to countries that don't have double taxation agreements. So those double taxation agreements are imperative to provide protection, and by that I mean inside a double taxation agreement you have what's called a tiebreaker clause. And the tiebreaker clause essentially says you cannot be a tax resident of 2 countries. You have to be a tax resident of 1, and that's the country you reside in. So Mariani, in your case, if you reside in the United States, the United States has a DTA with Australia. And with that DTA in Australia, DTA with Australia, it says that if you live in the United States and you spend more than 50 days, more than 45 days in Australia, and you fail those 2 factor tests, yes, the Australian tax office is going to say, Mariani, you are a tax resident. However, because you reside in the United States and it has a tiebreaker clause in the DTA, the IRS wins at the end of the day and you are not a tax resident of Australia. So if you're in a country like the United States, Singapore, most countries in Europe, the UK, they all have DTAs. So that's why these new rules aren't the end of the world. Where it's going to really affect folks are those countries that do not have a DTA with Australia. Hong Kong, Middle East countries, some countries in Europe as well too. So if you're looking at taking a job in Saudi and you're leaving Australia and you've only been provided a 1-year rolling contract, there is a very good chance that you may classify as a resident for tax purposes while living in Saudi, earning that income in Saudi. So everyone needs to be very, very careful. For those folks, is when you go through and look at these scenarios and map them out, it is going to really depend on what you're looking at with respect to. Sorry, I'm just trying to change screens here. With respect to what you're looking at, your particular country would dictate whether this thing is a good or bad thing for you. So watch that space. You need to really consider that. You need to go through and really consider the key considerations with respect to how they pertain to your particular country, and also to how they affect you on that financial side. So that's a good question, Mariani. So thank you very much for that. Karen's just done through a question with respect to Australia and Sweden on the DTA. So I think they do, Karen. For a quick, just give me a second here. I'm just going to quickly look this up, to tell you the truth, because I'm pretty sure they do. DTA, we've got a list here that makes our life a lot easier. Okay, yes, there is a DTA between Australia and Sweden. So, people are now going to start to learn the importance and the power of having that DTA. And one of the biggest things, I think, out of all of these things that we see right now is it is going to affect a lot of people in a lot of different ways. So start to do your homework and start to work out. This doesn't come into effect now. It's not going to come into effect in the next 6 weeks. It is going to come into effect in the next 1, 2, possibly 3 years. Obviously, the Board of Taxation recommended an implementation period of 1 to 2 years. They did talk about opt-in periods. They did talk about all these different sort of things. So the big thing we talk to clients right now is just be prepared. This should not be a surprise. This should not blindside you when it comes to looking at all these different scenarios. What we're looking at right now from the key perspective from an expat's point of view is what happens to someone in Dubai will be different for someone in the UK, different someone in Portugal, different someone in Sweden. So you need to start doing your homework. Obviously, you're more than welcome to reach out to us because, we're doing a lot of this for clients right now. There's a great saying about the 5 Ps, prior preparation prevents performance. And I think we're going to see that with a lot of folks going down the track when it comes to their planned movements going forward. If you're going back to Australia for a couple of years and then you come out, you may want to consider that. And the reason being is it may be harder to become a non-resident as you're leaving based on your circumstances. So just keep this in mind, folks. Just be aware of this, and some of the key considerations are really going to affect a lot of people out there. So, these new rules, they help some people. We've got clients who work on super yachts. Those super yachts, essentially they reside nowhere. They reside on the boat. So they technically are a resident of nowhere, which means they default to being a tax resident back in Australia. Under these new rules, as long as super yacht crews don't go back to Australia for greater than 45 days, they're a non-resident for tax purposes. So it makes life a lot easier on that front as well too. Even things like diplomat spouses, trailing spouses for diplomats. In the past, they've always been categorised as resident for tax purposes, even though, it's their husband or wife who's the ambassador. Under the new rules, unless that spouse is contracted by the Australian government, they can work as a local. So to me, that's a win as well too. For a lot of folks, you might have a split, family. Some family members live in one country and some are living back in Australia. And this we find certainly with places like Saudi. In the past, there's always that concern. The wife and kids are back in Saudi and back in Australia. The husband's in Saudi. How's that going to affect them? How are they going to manage that? Yes, he doesn't go back, but by the wife and the kids being back, is that a behaviour? Is that a domicile test? Under the new rules, the husband, as long as he doesn't return back to Australia for greater than 45 days, the wife and the kids can be back in Australia, and he will still be considered a non-resident. 45 days will get soaked up pretty quickly, and obviously that's not a good result. But as we're talking to a lot of clients right now, one of the things we're saying is, if 45 days does get passed, and your wife and children or husband and kids live back in Australia and you're overseas, it's going to be cheaper for you to meet them in Bali or Singapore or Thailand on a holiday than you just breach that 45 days, because once you breach that 45 days, you're going to fail the family factor test. Okay, guys, any more questions? We've got some more coming through here. Okay, so question on the property side. Let me just take a glass of water quickly, guys. Okay, question on the property side, and the question's from Mark, and he's saying, everyone's telling me property in Australia is going up, why is it not? I've always said there's a great saying, and this is both with financial advice and getting other investment advice, who's paying for lunch? And the reason why I say that is the person who's providing the advice, who's paying them to provide that advice. So with us, we're classified as a fee-for-service broker, fee-for-service firm. And what that means is we do not receive commissions, we do not receive back payments from anyone we recommend. We only pay by one person, and that's the client. So any advice we provide to the client is essentially in their best interest because they're the boss. When there's the fees being paid by someone else, there's always that ethical equation of conflict of revenue and how that works. And there's a whole industry back in Australia who's telling you right now, you should buy property, because the last 2 years it's gone up. But the reason they tell you that is because they want a transaction. So who's paying for lunch? It's a great one, that I heard years ago, and it just really changed, my mindset when explaining to clients the difference between fee for service and commission. When we talk about, an agenda in the background, who's paying the bills? Is it a platform that you're getting a commission from, like an Isle of Man bond and all that sort of nonsense that goes on in the Middle East and Asia? If they're providing advice, they're getting it free. They're not getting it for free. They're getting sold a product. So same thing with property as well. You need to do your homework. You need to look at what are the catalysts for a property market. Just because Freddie says the property market's going up doesn't mean it's going up. If there are headwinds starting to form and all the information that we're presented tonight is impartial, whether you guys go out and buy a property or not, it doesn't affect me. I don't get paid with it either way. But what I'm referring to is you need to consider everything and sort of keep your eyes up and don't just go along with the flow, because not a lot of professionals out there, or some, will have your best interest. They want to do a deal. They want to do a transaction and move on to the next one. So just keep an eye on that, folks, because that's a big one that we see time and time again. We have a lot of people go, oh, guess what? I got a great deal for you, and this is what's happening, and this is going to happen in 15 years' time. Yeah, what about the next 3 or 4 years? It's not just us calling this. All the economists for all the major banks are calling for the property market to fall in the next 12 months as well too. So good question, Mark, because there is that conflicted side in the background. You always just need to work out who's paying for lunch. Is it you? Are you paying that person? Are they getting that advice? Or is someone else paying that person and you're just receiving that advice? There's a big distinction there too. Another question too, coming from Tim in the UK. I reside in the UK. Obviously, the UK has a DTA. Can my family move back and forth, and will that impinge me or not? So yeah, great question. That comes back to what we were saying before, Tim. If your family decides to spend more time in Australia, it really comes back to you. Are you a resident or non-resident? Tax purpose will dictate based on that 45-day rule and also that factor test as well. If you want to be a non-resident for tax purposes, then you have 2 fronts. You can actually breach that 45 days and go back to Australia and fail all 4 factor tests. But because you reside in a country with a DTA, which is the UK, the top clause, you can be categorised as a tax resident of one country. And you think about it, the double taxation agreement avoids double taxing. So the ATO tried to say, Tim, you're a tax resident of Australia, and HMRC in the UK said, Tim, you're a tax resident in the United Kingdom. That's double taxing. So the DTA is designed to remove that. So that will certainly help a lot of folks who reside in those countries. At the moment, from memory, there's about another 5 DTAs in the process of going on. I know for a fact Greece is negotiating on theirs right now. So there are quite a lot of other countries that can be added to that list. Hopefully, inshallah, as we say here in the sandpit, some of the Gulf countries, we see a DTA forming there, but it's a wait-and-see approach. In the meantime, be forewarned is forearmed. You need to be careful, guys and girls, because yeah, there's no patience, I guess you could say, when it comes to how that looks. Right, guys, any other questions there? There's one being typed up right now, so while I'm just waiting for that one to come through, I'll, if there's no more questions, I'll wrap this up pretty quickly. So long story short, guys, you know, as I've talked about here, there's good and bad in what's going on right now. Economically speaking, going great, almost too good. Interest rates are going to be the determinant. Assets that are dictated by currency, by interest rates and liquidity, especially property, be very, very careful with that. On the other side, you know, interest rate increases do project prosperity, which is why we're seeing the equity markets grow, but also too, on the other side, you're going to start to see changes in the currency. You know, we talk about there's probably 4 major risks that expats have to manage when managing their money as an expat. The first one is currency risk. The second one is geopolitical risk. Third one is asset management risk. So currency risk is simple. And we've seen this a couple of times with clients, unfortunately, and the one that comes to mind is when the Brexit vote happened. You know, no one expected that result. The currency fell 15%. We had 2 clients who were virtually packed up, ready to move out of the UK back to Australia. They held all of their wealth in sterling. And they decided to defer and delay that move because the financial haircut would have been too large. So when we talk about these sort of scenarios, we talk about, you know, you need to make sure that you're balancing off dollar cost averaging money back to Australia. If you have some idea as to when you're returning to Australia, you know, that's great, because what it means is you can actually start to move money across, and I guarantee for clients that moved money across at 72 cents early this year, they probably thought, oh, it's a bit expensive. Now it's 76, they look like geniuses. You never know what the currency is going to do in the short, medium and long term. We have an idea, we can forecast, but it doesn't guarantee that. So when you're managing money, always make sure you're taking that into account. Geopolitical risk, not so much the case for folks in a lot of the major hubs like the UK and US, but obviously for regions like, you know, the Middle East where we are, or folks up near Ukraine, you know, you don't want to be holding all your assets in those jurisdictions if there are concerns, whether it's on a political front or a war front or both. And the last one is asset management risk. You know, we see time and time again people accruing the wrong assets as a non-resident. You know, people default to their Aussiness. You know, when you leave the country, you need to take the Cuba off because your passport is almost ripped up from an investor's point of view when it comes to managing money overseas. Here in Dubai, I'm not treated as an Australian citizen when it comes to taxing my assets back in Australia. I'm considered the same as an Emirati. So for those folks who live in the UK, you're a British citizen, as you might as well be. In France, same again, and so on and so forth. So don't default to how you managed your assets when you lived in Australia. Make sure you embrace and take on the tax differences of being a non-resident overseas and manage money according to that. So, righto guys, we're coming up to the 8:30 mark, which is when we said we'd finish this up. So as I said, we'll be sending out a recording of this this session along with slides. I'll also put some hyperlinks in there to some of the things we talked about with the podcast and also to the Facebook groups. If you have any questions, don't be a stranger. By all means, please reach out. We're friendly. We don't bite, I promise you. And we look forward to catching you guys on the next webinar, and hopefully we can be of assistance to you in the short term. Take care. Thanks, guys.